Let me ask you something uncomfortable. What if the most dangerous moment in your financial life isn't losing your job, isn't a stock market crash, isn't even a divorce? What if the most dangerous moment is the one happening to you right now, quietly, in the background, while you're paying your bills on time every single month? Because here's the truth that almost nobody in mainstream media is telling you. Millions of American homeowners are not losing their homes because they can't afford their mortgage. They're losing them because they can afford the mortgage, but they can no longer afford everything around the mortgage. And by the time they figure out what's happening, it's already too late. Today I'm going to show you exactly how this works, which homeowners are most at risk, where in the country it's hitting hardest, and what you can do this week, not next month, not after you miss a payment, right now to protect yourself. Stay with me because the numbers I'm about to walk you through are unlike anything the mainstream housing conversation is covering right now. Let's start with what we know. The U.S. housing market in 2025 didn't collapse the way the doomsayers predicted. Prices didn't crater 30%, there wasn't a 2008-style meltdown, and because of that, a lot of people tuned out. They heard no crash, and they stopped paying attention. That was a mistake. Because while everyone was watching for the big dramatic crash, a slow, grinding crisis was building underneath the surface, and it's now accelerating. Here's what the data actually shows. Total foreclosure activity in 2025, meaning default notices, scheduled auctions, and bank repossessions combined, hit approximately 367,000 properties. That's a 14% jump from 2024. And it's not coming from risky subprime loans this time. It's coming from regular, employed, bill-paying homeowners who simply got squeezed from every direction at once. Bank repossessions, meaning the bank actually took the house back, climbed roughly 27% year over year. These aren't people who bought homes they couldn't afford in 2005. These are people who bought homes in 2019, 2020, 2021, people who did everything right and still ended up losing. And here's the number that should stop you cold. December 2025 saw foreclosure starts spike nearly 46% compared to December the year before. That's not a blip, that's not seasonal noise. A 46% single-month jump in the beginning of the foreclosure process means the pipeline is filling up fast. The people entering foreclosure today are the ones losing their homes in 2026 and 2027. We are watching the front end of something big, and most people have absolutely no idea. Now, if you're watching this, you might be thinking, okay, but why? What changed? And here's where I want to flip the script on the usual explanation, because the answer isn't what most financial media is telling you. Every time someone talks about housing affordability or foreclosures, they immediately go to interest rates. Rates went up, people can't afford homes, crisis begins. Simple story, clean narrative, but it's incomplete. And for existing homeowners, it might actually be dangerously misleading. Here's why. If you bought your home with a fixed-rate mortgage, which the vast majority of American homeowners did, your principal and interest payment hasn't changed. That's literally the guarantee of a fixed rate. Your mortgage payment in 2025 is the same number it was the day you signed. So why are people losing those homes? Because the cost of ownership exploded while the mortgage stayed flat. Think about what it actually costs to keep a house in America today. You've got your mortgage, that's the obvious one. But then you've got property insurance, property taxes, HOA fees if you're in a community, utilities, routine maintenance, the water heater, the HVAC, the roof, and increasingly you've got climate-related costs that didn't even exist 5 years ago for most homeowners. Now here's what happened to those costs. Homeowners insurance. The national average annual premium for a homeowner with a mortgage has crossed $2,300 to $2,400 per year, and that's the average. In high-risk states, we're talking double or triple that figure. More critically, that number has surged nearly 70% over the last 5 years. 5 years. That's not gradual inflation. That's a financial gut punch happening in slow motion. And it's not just the price. The availability of insurance has collapsed in entire states. Major national carriers have pulled out of high-risk markets. When the big private insurers leave, homeowners get forced onto state-run residual market plans, the plans of last resort, which cost significantly more and often cover significantly less. So you've got higher premiums for worse coverage, or in some cases, no private coverage available at all. Property taxes. In most states, property taxes are tied to assessed value. Home values ran up dramatically during the pandemic buying frenzy of 2020 through 2022. Those reassessments are now hitting homeowners in waves. Even if you bought years ago and your mortgage payment hasn't moved, your escrow has, because your property tax bill went up. HOA fees. Across the country, HOA associations have been raising dues at historic rates to cover their own rising insurance costs, deferred maintenance, and inflation in vendor contracts. A fee that was $200 a month in 2020 might be $350 or $400 today, and it can be raised again next year. Put this together. Your mortgage, unchanged. Your insurance, up 60 to 70%. Your property taxes, up. Your HOA, up. Your utilities, up. The total monthly cost of keeping your home has climbed dramatically, even though your quote mortgage payment hasn't moved an inch. And because people anchor to that mortgage number, they don't see the full picture until the full picture is sitting on their kitchen table in the form of an escrow shortage notice or a lender letter. That is the mechanism behind this crisis. Not a crash, not a bubble. A slow, relentless squeeze. And the squeeze is worst in specific places, for very specific reasons I want to show you now. Let's talk geography, because this matters. In terms of raw foreclosure volume in 2025, 3 states led the country: Texas, Florida, and California. At the metro level, New York, Chicago, and Houston had the highest foreclosure starts among major cities. But here's what I want you to understand, and this is the part most people miss completely. This isn't just a coastal problem, and it's not just a hurricane states problem. The emerging driver of foreclosure risk over the next decade isn't just high insurance premiums in Florida or wildfire exposure in California. It's climate-related property damage in places nobody is expecting it, and the catastrophic gap between the risk those homeowners face and the insurance coverage they actually carry. Let me give you the research. A firm called First Street Foundation, they specialize in climate risk modeling for real estate, published analysis showing that for every 1% increase in insurance costs, the foreclosure rate rises by approximately 1%. 1 to 1. Now, multiply that by what's already happened. Insurance up 70% in 5 years. If that relationship holds, you're looking at a foreclosure rate impact that is massive, and it's only going to compound as premiums continue rising. But it gets deeper. First Street's modeling also projects that climate-driven foreclosures from flooding, wildfires, extreme wind events, and related damage could surge by as much as 380% over the next decade. By 2035, estimates suggest that up to 30% of all U.S. foreclosures could be directly tied to climate-related property damage or insurance loss. Today, that number sits around 7%. That's not a radical environmental prediction. That's a real estate financial risk projection. And it has direct implications for property values, lending standards, and insurance availability for millions of homes right now. Here's where it gets personal. The FEMA flood map problem. If your home sits in what FEMA calls a special flood hazard area, your lender requires you to carry flood insurance. That's the rule. So most homeowners inside those zones are covered. But FEMA's maps are seriously outdated. Millions of homes that face genuine, statistically meaningful flood risk are technically classified as being outside the special hazard zones. These homeowners have no lender requirement to carry flood insurance. Many don't know they need it. Many assume they're fine because FEMA said so. First Street looked at 29 major flood events across nearly 2 decades and found something striking. Homes located outside FEMA flood zones experienced foreclosure rates 52% higher than homes located inside the zones after flooding. Read that again. The homes inside the flood zones had lower foreclosure rates after a flood. Why? Because inside the zone, people had insurance. Outside the zone, they didn't. A flood hits. Your neighbor inside the flood zone files a claim, gets a check, repairs the damage, keeps the house. You're outside the zone. No insurance. The damage is real. The repair cost is real. The mortgage is still due. You have nothing to cover it. That is the gap that turns a natural disaster into a foreclosure. And it's happening in places like the Midwest, the Appalachian region, parts of the Mountain West, areas where people say, flooding isn't a problem here, right up until the year a flooding event proves otherwise. Now let me bring this back down to the individual level, because I want you to see yourself in these numbers. There's a specific type of homeowner who is sitting in the most danger right now, and I want to describe them clearly so you can self-identify, or recognize someone you know. Profile: the FHA borrower who bought 2019 through 2022. Here's why this group is uniquely exposed. First, the down payment situation. FHA loans allow buyers to put as little as 3.5% down. For a home purchased in 2021 at or near peak prices in many markets, that means equity was razor thin from day one. If local prices have stagnated or dipped since then, some of these homeowners may have very little or negative equity today. That matters because equity is your emergency parachute. When life hits you hard, equity is what lets you sell, refinance, or negotiate. Without it, your options are dramatically narrower. Second, the partial claim situation. The FHA partial claim is a loss mitigation tool that allows servicers to pay a borrower's missed mortgage payments and attach them as a zero-interest subordinate lien on the property. It's essentially a way to get current without paying the back payments immediately. During COVID, this tool was used heavily. The problem is that it's generally a one-time tool. Once you've used your partial claim, you typically cannot use it again in the same way. Here's the staggering part. In 2020, roughly 5% of FHA borrowers had used a partial claim. By 2025, approximately half, 50%, of FHA borrowers have already used that tool. The safety net that was there for them before is gone, and many of them don't realize it until they're already in trouble and calling their servicer looking for help. Third, the income to housing cost squeeze. FHA borrowers who qualified in 2020 or 2021 often did so at the low end of the income to payment ratio. Since then, the total cost of ownership, not the mortgage payment, but everything around it, has risen substantially. For some of these borrowers, total monthly housing costs have crossed from 30 to 32% of gross income to 38 to 42%. That's the stress zone. That's where one disruption, a car breakdown, a hospital bill, a temporary layoff, can cascade into a missed payment. Then two, then three. And here's the sobering research finding that ties it all together. Roughly 94% of mortgage defaults happen following an income disruption, a job loss, a serious medical event, a divorce, a death in the family. Almost nobody defaults purely because their costs got too high in isolation. The costs create the pressure. The pressure removes every margin of error. And then life delivers the event that breaks the system. The danger isn't just the event. The danger is having zero margin left when the event happens. If you are an FHA borrower, you already used a partial claim, you bought with minimal down payment, and your total monthly housing costs have crept above 35% of your gross income, you need to read the next section very carefully. All right, let's move from data to action, because that's actually why you're here. If anything I've said in the last 20 minutes describes your situation, even partially, here are 3 things you can do this week. Not next month, this week. Step 1. Run your actual risk assessment. Takes 10 minutes, costs nothing. Go to firststreet.org and type in your home address. This is a free tool. It gives you a property-level risk score for flooding, wildfire, wind damage, and extreme heat. More importantly, it gives you a projection of how that risk is expected to change over the next 15 to 30 years, because the risks are not static, they're shifting. What you're looking for. Does your home show moderate to high flood risk? Are you in a fire risk zone that's expected to expand? Is there wind event exposure that your current policy might not fully cover? Now cross-reference what the tool tells you with what insurance you actually carry. If the tool shows meaningful flood risk and you don't have a separate flood insurance policy, that is your gap. That is the exact vulnerability we talked about earlier, and closing that gap can be the difference between a flooded home being a claim you recover from and a flooded home being the beginning of a foreclosure. This takes 10 to 15 minutes. Do it today. Step 2. Calculate your real total monthly housing cost, the number your lender never shows you. Pull out a calculator or open a spreadsheet. Add up the following: your monthly mortgage payment, principal plus interest, your monthly escrow. This covers property taxes and homeowners insurance. If you're not sure, look at your most recent mortgage statement. Your HOA dues, if applicable. Your average monthly utilities, electricity, gas, water, trash. A monthly maintenance reserve. A reasonable estimate for a home is 1% of the home's value per year divided by 12. So a $350,000 home, roughly $292 per month set aside for repairs, systems, upkeep. Add all of that up. That's your true monthly cost of ownership. Now divide it by your gross monthly income, your income before taxes. If that number is below 30%, you're in healthy territory. You have buffer. If it's between 30 and 35%, you're in the caution zone. One major disruption could create serious pressure. Time to start reducing other expenses and building a reserve. If it's above 35%, you're in the stress zone. This is where lenders and financial advisors see the highest default risk. You need to take action now, not when things get worse. Most homeowners have never done this calculation. They know their mortgage payment, they don't know their actual cost of home ownership. You cannot protect yourself from a problem you haven't measured. Step 3. Know your equity, know your options, and make that call before you ever miss a payment. This is the step that actually saves homes, and it's the one most people take too late. If you're feeling squeezed, if your costs have risen, if you're concerned about your ability to keep up, call your mortgage servicer now. Not when you've missed a payment, not when you're 60 days late, now. Ask specifically about loss mitigation options. Servicers are required by federal regulation to discuss options with borrowers before the foreclosure process begins. Those options may include repayment plans, loan modifications, forbearance programs, or, if necessary, alternatives to foreclosure like short sales or deeds in lieu. If you're an FHA borrower, ask directly, have I used a partial claim on this loan? If so, what additional loss mitigation options are available to me? Know your equity position. Pull a free estimate from a site like Zillow, Redfin, or Realtor.com. If your home's estimated value is meaningfully above what you owe, you have options. You can sell with a profit. You can refinance if rates allow. You can tap equity if needed. Equity is flexibility, and knowing you have it can remove a tremendous amount of anxiety. If you're close to or below your loan balance, you need to know that now so you can plan accordingly, not after you're 90 days delinquent when your options have shrunk to almost nothing. The homeowners who lose their properties are almost never the ones who couldn't be helped. They're the ones who waited too long to ask for help. The phone call you're embarrassed to make today could save your home. Let me zoom out for a moment because I want to give you the larger context. What's happening in the housing market right now is not a repeat of 2008. The structure is different, the causes are different. In 2008, the problem was bad loans made to unqualified borrowers. It was a credit quality problem. The system was built on paper that wasn't worth what people thought it was. What we're dealing with now is a cost structure problem. The loans are real. The borrowers are real, the income is real, but the carrying cost of homeownership has grown faster than incomes, faster than appreciation, and faster than the financial cushion most homeowners have available. And unlike 2008, there's no simple regulatory fix for this. You can't pass a law that makes insurance cheaper in Florida. You can't legislate flood risk away in river towns in Missouri. You can't cap property taxes without unintended consequences for local governments. The pressures that are building right now, climate risk driving insurance costs, aging housing stock demanding maintenance capital, local government budgets driving property tax increases, these are structural pressures that will be with us for a decade or more. That's not a reason to panic. It is a reason to be informed. It is a reason to understand your specific exposure, your specific zip code, your specific loan type, your specific equity position, rather than assuming the national headline tells you what your situation looks like. The people who come out of this period in good shape will be the people who did the math early, identified their gaps, and took action before they were in crisis. That's what this information is for. Let me bring this all back to the one thing I want you to walk away remembering. The American housing crisis of this decade is not going to look like the last one. It's not going to be a dramatic, visible crash you can see coming from a mile away. It's going to be quiet. It's going to be thousands of families, good families, employed families, bill-paying families, reaching a breaking point not because they made bad decisions, but because the cost of staying put kept rising while their financial margin kept shrinking. The foreclosure pipeline already has nearly 300,000 families in it right now. People who are receiving letters, facing deadlines, and trying to figure out what comes next. And behind them, hundreds of thousands more who are one unexpected expense away from joining that pipeline. You have something those families may not have had: time and information, and 3 concrete steps you can take this week that cost nothing except a few minutes of honest attention. Check your climate risk, calculate your real housing cost, know your equity, and call your servicer if you need to. That's it. That's the whole playbook. 3 things this week. If this opened your eyes to something you weren't fully seeing before, share it. Send it to a family member who bought a home in the last 5 years. Send it to a friend who's been feeling squeezed but can't quite figure out why. Send it to anyone you care about who owns a home in this country. Because the people who get through this decade in one piece financially are going to be the ones who were paying attention when it mattered. And right now, it matters. I'll see you in the next one.